Madam President, I appreciate my colleague from Michigan being out here, as she has repeatedly, to talk about how our process oftentimes breaks down and what the consequences are, because there's probably no bigger consequence than what's happened to the state of Michigan. And she fights every day to make sure that we are aware of what will help our economy and help Main Street. And so I thank her for that, and I thank her for being out here to urge us to get off of a filibuster and onto an important legislation that I think will help our country. But I'm here also to talk about something that I want to make sure as we enter this floor debate that people aren't confused about. That is, that we've made choices in the past that really have helped accentuate the situation that we're in. And if we're going to get out of this situation, we have to be honest with ourselves that this is a time when we need to do our job and make sure that we understand the opportunity to make sure consumers are protected. I want to start, Madam President, by talking about the Commodities Exchange Act, because there's been a lot of debate here about what various committees have oversight and what the important issues are here. And for me, there's no more important issue than making sure the Commodities Future Trading Commission, which has oversight of financial indexes, has the authority to regulate what are called derivative markets. The reason I say this is so important is because it really is the fact that we allowed legislation to pass here in 2000, the Commodities Future Modernization Act, that literally deregulated these derivatives. Well, more specifically, it prevented us from regulating them. We had a Commodities Future Trading Commission chair, a woman named Brooksley Bourne, who saw what damage was happening in 1998 with these derivatives because they were unregulated. And she tried to do something about it. And she tried to do something about it because the Commodities Exchange Act's oversight is to deter and prevent price manipulation or any other disruptions in the market, to ensure financial integrity of all transactions and avoid systemic risks, and to protect participants from fraudulent or abusive practices. Now, that's what their charge was. And when she saw in the marketplace that there were these products that were being used that basically thwarted this act, she proposed regulating derivatives. So that is in the 1998 timeframe. So this problem has been around for a long time. She said, as we saw the demise of long-term capital management and incurred a financial crisis at that time, she said, let's make sure we are regulating these products. And what happened is that she was basically run out of town for her views. She was the chair of the commission at the time, and a bunch of people, basically influenced by Wall Street, came down to Washington, D.C. and said, you know, that's the wrong idea. We don't need to do this. This problem isn't going to be an issue for us. And so not only was she prohibited as the chair of the Commodities Future Trading Commission to fulfill this act, to make sure that we regulated this market, not only that, legislation was passed here by the Congress prohibiting us from regulating these derivatives. Now imagine that. You actually had a chair of the commission doing their job. You actually had her calling out a problem in the market on her responsibilities and oversight. And not only was she told no, that she couldn't regulate those, Congress prohibited her from doing that in the Commodities Future Modernization Act. Well, how did we get, to that situation before? I get it, because I had to live through the Enron crisis in our state, and a lot of people cooked up off-book accounting, and people at first said, oh, it's a bunch of environmentalists not allowing us to have energy supply. That's why we have an energy crisis. Or then people said, oh, well, we're having an energy crisis just because we don't have enough refineries. Well, we found out that it was people manipulating supply and demand with various schemes called Death Star, Get Shorty, a variety of things that all came down to this, off-book accounting. How could you fool the accountants into believing that your scheme was really legitimate? So it should be no surprise that in 1994, that in a little retreat effort, some of us go on retreats and talk about our policy issues. Well, here, some of the titans of Wall Street went down to Boca Raton, about 80 JP Morgan bankers, and started to wonder if there was a way to create derivatives that could bet on whether bonds or loans would default. Okay? That's what they did. They were down in Boca Raton saying, basically, how can we do off-book accounting to figure out ways in which we can bet on these things? So that's what happened, and that was the start of this. And Brooksley Born, a few years later, after she saw them, called them out on it, said, let's stop it, and basically was prohibited from doing it. So what happened when we prohibited the derivatives from being regulated? Well, one of the CFTC personnel at that time basically said that all the fundamental templates that we had learned since the Great Depression that are needed to have markets function smoothly were gone. These are things that we had put in place after the last fiscal crisis. We put them in place because we knew we had to protect things. Now, the other side of the aisle led the charge on that deregulation, led the charge on the deregulation of derivatives and said, let's keep our hands off. And I would say, Madam President, at least 4 times we've had votes on various derivative measures, and the majority of my colleagues on the other side of the aisle have said, no, let's don't re-regulate them. Now, I'm all for hearing what they have to say today, but this is an important issue, and let me explain why. Because when you look at capital markets, you have to have transparency. If you don't have transparency, people don't know what's going on, and products can be manipulated. So after the 2000 Commodities Future Modernization Act, basically on derivatives, you had no transparency, you had no capital requirements, you had no prohibition on fraud, you had no prohibition on manipulation, and no regulation of the intermediaries. Why are we surprised that we ended up in this situation? Because if we basically took what had been the fundamentals of the last fiscal crisis and put them in place in a law, and then basically were warned and we deregulated them, why are we surprised that we ended up in this situation? Because after deregulation, what it meant, if you were doing trading, at least on these derivatives. Now, on other products, you had certainty and you had predictability. But on these products, let me be more specific. You had what were called dark markets. And that meant because you couldn't see into these dark markets, you didn't really understand what was being done. And I know that our colleague, Senator Levin, is holding a hearing today, and he's going to get to the bottom of exactly what was going on in those dark markets and who was trying to manipulate them. But the fact that they were dark and not traded meant that you couldn't see the price that somebody was paying and thereby understanding what was going on in the market. So you had no transparency. And you also had, no requirements to keep records, no large trader reporting, which would have been things that the CFTC would have said, oh, I can look at that and see whether manipulation is happening. You had no speculation limits. Another thing that happens on the stock market or on trades that happen now, I mean, we hear about it all the time, is that if somebody thinks that somebody is messing around with the market, you can have limits. You can come in and on an exchange, or an agency could come in and say, we're going to stop that kind of trading because we have concerns about what's going on. And we also know that there was no capital behind these bets as well, which is very alarming to a lot of people that the synthetic CDOs were cooked up and had no capital behind them. And I know my colleague, Senator Dorgan, has been out on the floor and is talking about legislation or an amendment he's going to be offering on the Senate floor to make sure that we close that. But what it created was just a high risk for fraud and manipulation and excessive speculation. That's what happened. That's what happened. So when you deregulate the derivatives market, what happened? Well, it should be no surprise, again, to find out that when we deregulated it, the market exploded. Here's where we were in 1999. There were some derivative products, but now look at it. It peaked at $700 trillion market. It somewhere leveled off now here at $600 trillion. A $600 trillion market in derivatives grew because we created a dark market opportunity in which people couldn't really, not everybody could really understand what was going on. And certainly the regulators who used to have a day job of overseeing this were prohibited from doing their day job. And I should add, Madam President, not only were the regulators prohibited from doing their day job, in that Commodities Future Modernization Act of 2000, we also had a provision in there that said states aren't able to use their authority to look in to these markets and market activities as well. So we did two things. We prevented the federal regulators from doing anything, and we prevented the state regulators from doing something as well. And now we have this unbelievable market of activity. So my colleagues on the other side of the aisle like to talk about innovation. Well, I know a little bit about innovation. I worked for a company that was a startup company. And when I look at that, yes, you have to have financial markets on Wall Street that help those companies get financing through their very early stages. That's what's so important about our financial markets operating effectively. But you can see from this chart, or maybe you can't. Maybe you can't see from this chart because it's so hard to see. But at the very bottom here is a little yellow line. And that yellow line represents the assets that people, the loans that these banks are making, the amount of money that's in loans and capital going to businesses that are the true ideas of innovation. Now, there's a lot of innovation here in derivatives. Now we know what it is. Dark market derivatives that cooked up things like CDOs and synthetic instruments to basically bet against bonds because somebody had securitized loans to banks that were risky bank loans anyway, and then tried to make somebody believe that that was a great way to cover them financially. So all of it was just a risky game, and that's what we're doing. So we're not helping the American economy in investing in Detroit or investing in software or investing, not the way we used to. We're basically investing, and people are making a ton of money in dark market derivatives. And so that's why it's so important that we get out here and we fix this legislation. And just to give you an idea of where people are making the money, because I know some people like to say, well, let's get out here and make sure we do something for small business, which I think it's incredibly important that we do that. But you're not going to get the big banks to make a bunch of loans to small businesses, as that last chart just showed you, when they can make money in dark market derivatives. And this chart here shows the increased profits that they have had since 2008. So you've actually had a decrease in lending. You've actually had a decrease in the amount of capital going out to the tune of something like $574 billion. And you've actually had an increase in trading profits. So we know where the money's going. Wall Street's not putting money into Main Street. Wall Street's putting money into Wall Street dark markets. And we have to get on this legislation to fix that. So what would we do in this legislation? Well, if my colleague from the Agriculture Committee's mark is put into this legislation, as I believe the leader is going to do, then you have a choice of having an unregulated market, or with this legislation, a truly regulated market with exchange trading. Now people say, well, what does that mean, exchange trading? I don't understand. What is that going to solve for us? Well, just as I said how dark the market was and no one knew what was going on, when you have a product that is traded on an exchange, you actually have transparent pricing. So people can see what the pricing is, just like this situation's being described right now in the Senate Oversight Committee about people didn't know what was going on or who was paying what or who was behind what bets. You have transparent pricing. And you have real-time trade monitoring. You know, because someone is monitoring those trades, you know exactly what's happening in the market and who's moving what and how they're moving it. And you have a transparent valuation. You know, if you go back and, or if you have time and you read this latest book that's out by Michael Lewis, The Big Short, he talks about how people didn't know exactly what was going on the valuation of this because it was being hidden from them. And so they had no way of understanding exactly what the value of these products were. That's why this scheme was able to be perpetrated on people, because they didn't know what the true valuation is. And if you have exchange trading, you actually have speculation limits and you have public transparency. So when we're out here debating this, and I hope my colleagues on the other side of the aisle will support exchange trading. I heard one of our colleagues on the other side of the aisle say, well, I don't think that's the solution. Well, by my book, it's absolutely the solution. It's absolutely the solution. Just as it is for the stock market. Who would buy stock on the stock market if you didn't have oversight of the exchange? If you didn't have these kinds of things, transparency, real-time monitoring, speculation limits, public transparency, who would go buy stock on the stock market if that was the case? So why do we think that derivatives can operate in the dark? They can't. And the other thing that we will be talking about here on the floor is that unregulated trading doesn't have any capital behind the trades. And if you actually had a clearinghouse involved, if you had exchange trading and a clearinghouse, then you actually have capital behind these trades, and people know that somebody has the ability to deal with this transaction that they are betting on. So, Madam President, these are the things that we need to do. These are the things that are critical to the type of reform that we need to get done. I am concerned that we are not going to get to this legislation, that dark market is going to continue to operate that way, or that people are going to propose loopholes to basically water this legislation down. And, you know, we've had a lot of conversation about loopholes, and one of them is the end user loophole. And basically, any kind of loophole in this legislation, it's kind of like water. The money's going to flow where it can. And if it's a dark market, that's where the money is going to flow. We had a hearing of the Commerce Committee in 2008, 6 or 7 months before the big bubble burst, and George Soros came to testify, and he basically said we're in a bubble, inside of a bubble, and it's going to cause, great concern. He knew then, because he knew what kind of activity was going on. And he talked in his testimony how important it was that if you applied regulation, you had to apply them both to the regulated and the unregulated market. Because if you don't apply it to the unregulated areas, then what happens is all the money just moves over to the unregulated area. So I appreciated this New York Times editorial that basically said if end users are exempted, then trillions of dollars worth of transactions could avoid the exposure and stability that comes with exchange trading. So that's what we're going to be debating out here, about whether you're going to have the kind of oversight and you're going to make sure that we end up putting the kinds of regulations in place that we need. Let's just go to that strong derivatives reform, as another New York Times editorial said, strong derivatives reform is a matter of putting the taxpayers first, ahead of big banks and corporate Americans that are fighting hard for a return to the risky business as usual. We don't need risky business as usual, Madam President. We need to reform these markets. Let's get capital flowing again to innovation in products, in services, in important areas of our economy, and know that a fundamental rule to markets and to capitalism is to have transparency, and that the legislation that we're considering will do just that. Hopefully the Republicans will say what true reforms they are for and realize that in the past they have been against some of the derivatives reforms that would have stopped us from having this crisis. So I thank the President and I yield the floor.